I'm Adrian Helfert. I'm excited to be here at Westwood, having joined from Amundi Asset Management in London late last year. I'm the head of multi-asset solutions, and our team is leading the expansion into multi-asset products as absolute return, outcome-oriented, and global total return products. Multi-asset and income portfolios are a growth area for Westwood, as we can display the skill and judgment as true active managers. A bit about me. After the military, I joined JP Morgan as an investment analyst 20 years ago, and I've worked across the spectrum of equity and global fixed income. Most recently, I've been with Amundi Asset Management and in London, working as a global portfolio manager for a leader in global investment solutions and sitting on the senior investment committee advising across all of our multi-asset solutions. My family and I are very happy to be in Dallas, enjoying the blue sky and working with very like-minded colleagues on fundamental investing. A quick comment on the broad markets and the ups and downs of the equity market we've seen over the last year. Currently, this is driven by the trade-off between central banking policy and what's happening on the economic real growth side. We had the U.S. Federal Reserve deliver a dovish message to the markets. Their continued support with liquidity and monetary policy returns their punch bowl to the party after effectively pulling it away for the last 12 to 18 months. The U.S. had been shrinking their balance sheet, but now that will remain at an elevated level, above our expectations, which should keep support in place for the economy and suppress volatility. In addition, where they had previously seen 2 hikes this year, it's been reduced to 0. They will join the other global central banks in providing punch bowl stimulus to their respective economies. What keeps me up at night is, what does the Fed see that is concerning enough to slow the balance sheet taper and be dovish, while stock markets are strong and many economic indicators, like unemployment, are very strong as well? It's back to the effective handoff between real growth and central banking support. In general, I think about the U.S. economy operating in cycles that can either be vicious or virtuous, and post the global financial crisis, this has been a virtuous cycle, with increasingly plentiful jobs leading to increasing consumer sentiment, which then leads to stronger consumption, historically 75% of the U.S. economy, which then leads to good corporate earnings, and subsequently back to more jobs. Now, wage growth has been slow to come by during this cycle, and only recently are we seeing more on the corporate capital expenditure side. This lack of inflation is something that is concerning for central bankers and is likely a source of the dovish bias that we see. While there are a number of catalysts that could impact the environment that we are in, one of the most important for us to follow is the trade negotiations between the U.S. and China. We are fundamental investors, and the outcome of these trade negotiations can impact things like revenue projections and gross margins for both domestic and international companies. Some could potentially benefit, and many could see margin and revenue pressure if there's an inability to come to a positive conclusion. At current, the trade policy uncertainty in itself is a part of the risk premium in the market, and we look for resolution to provide a lift broadly, and understanding the fundamentals helps us invest in companies that stand to benefit.